All right, let's get right into it, because something huge just went down in the markets. And you know what? The real reason why is probably not what you're hearing on the news. We're going to pull back the curtain and show you the hidden mechanism that's really driving all this chaos. First, just let this number sink in for a second. $6 trillion. That's how much market value just, poof, vanished into thin air. And the craziest part? The speed. This wasn't some slow, grinding decline. Nope, this was a catastrophic collapse, and the whole thing happened in just 48 hours. But this is the real mystery. This is the question at the heart of our entire explainer today. See, we're always told that tariffs create inflation, right? And we're also told that when inflation hits, you're supposed to run to so-called safe haven assets like gold. So why on earth did gold get hammered right along with everything else? If we can answer that, we unlock the whole story. Okay, so let's play detective. First step, let's survey the scene of this $6 trillion wipeout and try to figure out what on earth actually happened. What's really wild is just how widespread the damage was. I mean, this wasn't just about a few tech stocks getting hit. We're talking about the S&P 500, the NASDAQ, the VIX, the market's fear index. It spiked to levels we haven't seen since the depths of 2020. But it was also industrial stuff like oil and copper, and most confusingly, gold. Literally everything went down together. There was absolutely nowhere to hide.
Now, the easy answer you'll hear everywhere is, oh, it's just uncertainty. But, as this quote puts it so perfectly, that's about as helpful as telling someone their house is flooding because, well, water is wet. It doesn't explain why. It doesn't show you the mechanism. So we're going to go deeper. We're going to show you the broken plumbing that's actually causing this flood.
So, to find the source of that flood, we have to start with the very first link in the chain reaction. We need to get real about what a tariff actually is, and more importantly, who really ends up paying for it. The common belief is that when a tariff gets slapped on something, the foreign company just eats the cost. But the data? It's not even close. The numbers are crystal clear. They don't. As you can see right here, a whopping 90% of that cost gets passed straight to US importers, and from there, right to you, the consumer. It basically works just like a giant sales tax. And that leads to a very direct, very simple consequence. This isn't about feelings or fear. This is just math. Step 1, tariffs make business costs go up. Step 2, higher costs mean future profits are going to be lower. And since a stock's price is really just a bet on those future profits, well, when the outlook for profits goes down, the stock price has to follow. It's a machine. It's just simple arithmetic. But wait, it gets even more complicated. The fallout doesn't stop with stock prices. This new tax creates another massive problem. It backs the Federal Reserve into a corner. I mean, a truly impossible position.
See, tariffs do two things at once. They push prices up, that's inflation, but at the same time they slow down the economy. And that toxic mix has a name, stagflation. And stagflation is like kryptonite for a central bank. It pretty much makes their main tools totally useless.
Just think about the trap they're in. If the Fed tries to help the slowing economy by cutting interest rates, they're just pouring gasoline on that inflation fire. But if they raise rates to fight the inflation, they risk completely crushing the economy and causing a deep recession. They're totally stuck. There is no good move. And this is the absolute key. For something like 15 years, the market had this built-in belief, this insurance policy. It was called the Fed put. The idea was basically, hey, don't worry, if things get really bad, the Fed will always step in and save us. But now, because of this inflation problem, that insurance policy is off the table. It's gone. And the market just had that terrifying moment where it looked down and realized it's been flying without a safety net this whole time. Which brings us all the way back to our big mystery, right? If the Fed's safety net is gone and inflation is a real threat, why on earth did the ultimate safe haven, gold, fall right alongside everything else? Okay, so over the past couple of years, a ton of money, we're talking over $70 billion, poured into gold funds and ETFs. But here's the kicker. A huge chunk of that was leveraged. In simple terms, that means it was borrowed money, all betting that gold prices would keep going up. So what happened next was like a chain reaction of dominoes. It was purely mechanical. When the market took that first little dip, all those leverage players had to sell a bit of gold just to stay within their borrowing limits. But that selling pushed the price of gold down even more, which triggered what are called margin calls. And that's when the real panic starts. They were forced to sell anything and everything they could turn into cash, fast. Stocks, oil, and you guessed it, even more gold.
And this is maybe the single most important insight of this whole thing. The reason they were selling gold wasn't because they suddenly thought gold was a bad investment. Not at all. It was a forced liquidation. It was a fire sale. They were selling because the math of their loans forced them to, not because they made a judgment call on its value. Think about it this way. They sold what they could, not what they wanted to.
Okay, so now that we've seen the hidden mechanism at play, what does all this tell us about what's probably coming down the road?
Now, I want to be really clear. This is not a prediction that history is going to repeat exactly. It's a historical parallel. Back in 1930, we had the Smoot-Hawley tariff. It was supposed to protect American industry. Instead, other countries retaliated, global trade completely seized up, and it helped turn a stock market crash into the Great Depression. The underlying mechanism, tariffs raising costs and shrinking trade, is identical. So with that in mind, here are 3 big things to keep an eye on. First, expect these supply chain problems to stick around for a while, which will keep inflation high. Second, you're going to see this really weird push and pull with the US dollar. It'll probably get stronger in the short term as people scramble for safety, but weaker in the long term. And third, and this is the big one, you have to watch for the moment the economic pain gets so bad that politicians demand the Fed turn the money printers back on.
So what's the real takeaway from all this? First, try to focus on the mechanism we just walked through, not the crazy day-to-day headlines. Second, always remember that fire sale idea. An asset's price can be very different from its long-term value. Third, keep your eyes peeled for that moment the Fed is eventually forced to pivot back to easier money. And finally, try to see this not as just pure chaos, but as the system doing a painful but necessary cleanup of all the risky leverage that's been built up.
Which leaves us with this one big final question to think about. Is what we're witnessing just a chaotic, destructive collapse? Or is it actually the painful but necessary start of a great repricing? A moment where all the old assumptions of the last 15 years are finally cleared away to prepare the ground for whatever comes next. That's what the mechanism we talked about suggests you should be thinking about.